It's great to be with you all again today. This is the third or fourth, I think, in a series of PPP webinars that Steve and I have done together. So I'm a partner in the Boston office of Nixon Peabody, and I have been following the PPP program incredibly closely since March of 2020. And Steve and I have been in contact and kind of discussing the interplay between the accounting side of the house and the legal side of the house on the PPP program. And I know that many of you have been kind of living through PPP as borrowers. I'm sure that you'll agree with us that the program has not exactly been a model of clarity, but we are here today to try to bring some clarity to the chaos with respect to the second round of PPP second draw loans, help you understand the new changes that were just passed in the recent law. We do not know everything yet. We still have some questions ourselves, and we do expect further guidance from the SBA, but we'll do our best to try to orient you today in what we do know now. And Steve, do you want to introduce yourself as well to the audience? You just have to unmute.
Sure, it's Steve Mizrach. I'd like to, I'm a partner at the accounting firm Dorfman Mizrach Thaler. And, Morgan and I have, done this, as she said, 3 or 4 times, maybe more. And we kind of consider ourselves PPP buddies now. I wish we could be buddies in something else like tennis or golf or, going to a restaurant, which I'm sure we all sorely miss. But this is the plight that we've been given. And, our job is to try to help, educate you so that you can make some sound business decisions and get as much money as you can that's available through the federal programs. So looking forward to speaking with you again.
Thanks, Steve. And Steve and I did review all the questions that were submitted prior to the webinar, so thanks for submitting those. There were a fair amount that we received, so we're prepared to address most of those topics during our presentation. So without further ado, we will kick it off. Okay, here's Steve and I. Here's our contact information. We're more than happy to discuss your particular situation if it's not answered on our webinar today. And disclaimer, this is not legal advice. This is information that we're providing to our friends and colleagues. And if you do want specific legal or accounting advice, reach out individually to Steve and I later on. Okay, so overview of the new law. It is the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act. Signed into law December 27, 2020. It's got a $325 billion investment, including $284 for PPP, both first and second draw loans, additional monies for the EIDL program, additional Section 7A loan relief, and then the $15 billion Save Our Stages Act, which a small number of you may be eligible for that. We're not touching on that today, but keep that in mind that you can't get both PPP and the venue provision grants. So if you believe you may be eligible, you might want to look into that before putting in your PPP application. Okay, so an overview of just the PPP program generally as it stands today. So they've reopened the program for both first draw loans. So if you're a first-time borrower, you've never done PPP before, you'll be doing a first draw loan. If you've already taken a first draw loan, you may be eligible for a second draw loan, which has a narrower eligibility requirement. Note that the affiliation rules for eligibility are waived for both of those if you're in the accommodation and food services sector. So that's lodging, prepared meals, snacks, food and beverage consumption with the NAICS code 72. So there are some special provisions for folks in that industry. You can apply for one of each loan. So you can get one first draw loan, one second draw loan. The deadline to submit the applications for both is March 31st, 2020. And something to pay particular attention to is that lenders are expressly permitted to use their own form of note. They can use their own portal. A lot of them, you may have seen, they created their own portals and kind of websites to intake information, and they're allowed to do that. So what you're seeing may vary by lender, and definitely pay particular attention to that note, the promissory note that you sign from the lender, because lenders can put in conditions that are not part of the PPP program. For example, we've seen lenders put in a condition that makes certain events an event of default, like a change of ownership of the company. So just pay attention to the terms that are being put upon you by your lender. So regarding the certification, so a lot of people have asked about this. I'm going to touch on this a little bit later on, but as it stands today, it looks like both first and second draw loans should be prepared to make the economic necessity certification. And then for second draw loans, you have to make an additional showing that you have a decline in revenue. And we're going to talk a lot about that and how to substantiate that and what documentation you need. So I will cover that in detail later on. And the other kind of high level thing to touch on, they've now changed the loan covered period. So it can now be any period between 8 and 24 weeks following the funding of the loan. So the borrower gets to choose that period, which is good. It gives you a lot more flexibility about how long you will have to meet the program requirements and to use those funds. So all lenders are open as of today for accepting applications. Again, some lenders may not have their portals up yet, so definitely check in with the lender that you're going to use to see if they're ready to accept. But as of today, lenders are able to submit requests through the SBA portal at least. So definitely check in with your lender to see if they're ready to accept applications. All right, here's a little comparison to help orient you in the differences between the first and second draw loans. So there's two aspects of eligibility, size and need. For size, for first draw loans, no more than 500 employees per physical location. That actually has to do with restaurants. So no more than 500 employees. And when you're talking about size, you have to remember to apply the SBA's affiliate rules. I'm not going to go into detail about this because it could get quite complicated depending on your corporate structure. But basically, the SBA has a very broad definition of affiliate. An affiliate can be found through common ownership, common management, through common identity of interest, so close relatives is an example. And you have to include all of the employees at each of your affiliates to determine if you get to this 500 number for the purposes of first draw loans. For second draw loans, it's no more than 300 employees between all of the company's affiliates. So, and if you are, again, in the restaurant industry or accommodation food services industry, it's actually only 300 employees per physical location because they waive the affiliate rules for that sector. So keep that in mind as well. It basically opens up and broadens eligibility for restaurants and accommodation like hotels because those have been known to be particularly hard hit economically by the pandemic. So there is a little bit of a wrinkle there. The second is need. So for first draw loans, they require you to make this certification that's gotten a lot of press and attention. Economic uncertainty makes the loan request necessary to sustain ongoing operations. And when reviewing that loan, the SBA has made clear that for loans under $2 million, they're going to presume that certification was made in good faith, unless they're presented with evidence to the contrary. So for second draw loans, this is kind of an interesting wrinkle. Steve and I were talking about this earlier, par for the course of PPP. The new law and the regulations don't require that borrowers make this economic necessity certification for second draw loans. However, the second draw loan application has the certification on it. It has those words on it. So in practice, it looks like borrowers are being asked to make the certification, even though it's not mentioned in the law, it's not mentioned in the regulations. So our best advice is be prepared to have to consider and make that certification as you did with the first draw loan, that the terms haven't changed. There has been limited guidance that the SBA has put out about it. They basically say they want you to consider your, quote, sources of liquidity when determining whether or not you need the loan or whether or not your operations can continue in the short term. So it's kind of a subjective standard. Happy to discuss further with folks that are having issues with that. We've been helping our clients document that certification and prepare for audits on that. But long story short, be prepared to have to make it for second draw loans, even though it's not in the law currently. In addition to that certification for second draw loans, you're also going to have to substantiate a revenue reduction requirement. So it's for any calendar year quarter in 2020 versus 2019, you have to be able to show a 25% reduction. And they've also said that you can do a year-over-year reduction instead of calendar quarter. So you can use tax returns to substantiate that. If you can show a 25% reduction in the entire year, 2020 versus 2019, that's another way you do it. So they give you some optionality there. I had a lot of clients ask, can we choose any 13-week period? The answer is no. They specifically say calendar quarter. So that is what we're stuck with. Maximum loan amount For first draw loans, it's 2.5 times average monthly payroll or 10 million, whichever is less. And for second draw loans, 2.5 times average monthly payroll or 2 million, whichever is less. For restaurants and the food services accommodation industry, again, they've increased that amount, so it's 3.5 times average monthly payroll for those in that category. So you can get a little bit higher of a loan amount if you're in that industry with the NACS code 72. Loan term is 5 years. I do want to note, if you received a first draw PPP loan prior to June 5th, your loan term is likely 2 years, your note. And the PPP Flex Act explicitly permits borrowers to request that lenders extend that to 5 years. If you're interested in that, you might want to reach out to your lender to see if you can change the term of that note. Just wanted to point that out. And then, so regardless of the fact that affiliate rules may be waived for some, and that you're allowed to have affiliates getting different amounts of loans, they still put a maximum aggregate cap on entities in what they call common corporate ownership, which is a different definition than affiliate, but it's much more straightforward. It's basically, what we think of traditionally as parent sub. So for first draw loans, they have a $20 million aggregate cap, and then for second draw loans, it's $4 million. Steve, I think you were just trying to chime in there. Do you want to unmute yourself?
Yeah, sorry. So just a couple of points, just going back to what you were talking about, Morgan.
Sure.
First and foremost, guys, when we're going through this certification process, or when you're going through it, something that we spoke about last time, just make sure that what best practices, and, Morgan could speak more to it, being the lawyer, but it's a good idea to document, the state of the mind, your state of mind at the time you're signing the certification, saying that, there's the economic uncertainty that's causing you to want the money. I think that's really important, just to have it documented as to the reasons why, because you may not get audited for 3 or 4 years from now, and you have to, or 3 years from now, and then you try to recreate what you were thinking at that particular point in time. And the other aspect about the 25% year over year, or just submitting tax returns, just to kind of reiterate, all you need is 1/4 of this 25% reduction, and then the certification piece. And we'll talk about, how one justifies, that their revenue was what it was, and how one defines gross receipts. But the other important part of that is that, using your tax returns is really just a convenience for you. If your overall revenue is down 25%, you don't need to bother with the quarterly calculation. So I just wanted to kind of bring those 2 points into the fray.
Yeah, that's a really good point, Steve, about documenting the good faith certification of economic uncertainty, economic necessity. We've been helping clients with that, but Steve's absolutely right. The relevant time frame is the day you apply for the loan. And that word economic uncertainty, what does that mean to your business? I mean, that could mean you're worried about your supply chain, your vendors, all these things that may be in the mind of the company that makes it feel like it can make that certification. You want to put pen to paper on that, have a memo to file, just documenting that. And the SBA does require you to have documentation in the file to back up your certification. Even if you're under 2 million, you still are supposed to have documentation substantiating that. And it doesn't have to be, you don't have to make it fancy. It doesn't have to be, 30 pages, but even a 2-page memo can go a long way to codifying, what was in the company's mind, quote unquote, so to speak, years later, because the SBA can audit these loans for up to 6 years. So, it's going to be hard to remember what it was like back in March, hopefully, a couple of years from now. So that is a really good point that you want to document that. And we've been helping clients do that. Okay, so I'm going to move on to PPP eligible cost. Thankfully, this is the same for both first and second draw loans now. So the first is the definition of payroll costs. You'll remember this from the first draw loan. It's a very important definition because it's used not only to calculate your loan amount, because your loan amount is average monthly payroll costs times 2.5, right? So payroll cost is how you figure out your loan amount. So you want to get it as high as possible. And then it's also on the back end how what you have to spend 60% of the loan on to maximize your forgiveness. So it's a really important definition. And it's kind of changed over time, but here's the state of play today. So it includes salary, wages, commissions, cash tips. Bonuses are included, which wasn't clear for a long time, but they put out an FAQ that explicitly said that. payments for vacation, parental, family, medical, or sick leave, health care premiums, disability, vision, dental insurance premiums, allowance for separation or dismissal, retirement contributions, and then state and local taxes assessed on employee compensation. Those are all part of the definition of payroll costs. Non-payroll costs, we have the usual suspects that were part of the first PPP program, so mortgage interest, rent, utilities, interest on other debt, refinancing of an SBA EIDL loan, and then they've added some fairly expansive, although, a couple caveats that we'll talk through, new definitions for other non-payroll costs that you can look to spend the loan on. So the first is covered operational expenditures. So this includes a lot of things like cloud computing services, HR services, payroll services, any kind of like administrative expenses that you have on the operations side can generally fit in there. They added covered property damage, which is kind of a political thing to address if for instance, if your property was damaged in the riots that happened this summer, you can use the PPP loan to cover costs for that. Covered supplier costs, which at first glance appears to be a big new category, but I'm going to ask Steve to talk about some caveats to that. And then covered worker protection expenditures, so PPE. If you had to buy plexiglass screens or masks or things to help protect your workers, you can now use those as an eligible PPP expense.
Yes.
Steve, you want to talk about the supplier cost issue?
Yeah, sure. And again, just to kind of reiterate what Morgan said, that even though they've added these new categories, just to be mindful of the fact that not only does it apply to 2021's or the second drawer, if you want to call it the second drawer, but this also applies retroactive to the first drawer that you took, way back in May, June, or July. So this is an opportunity for those of you that have not applied for forgiveness to, re-examine additional expenses that kind of can help you fill the 40% bucket. And when we get to talking a little bit later about the employee retention credit, which is a big thing that we'll cover, you'll see why this is so valuable. But getting back to the covered supplier expenses, there is some interesting aspects of the law that you should take in consideration. So basically what they're saying is that if you have certain expenses that are integral to the operation of your business, let's say you're in the food business and you're doing your food purchases, or you're in the medical business and you have dental, medical or dental supplies, things of that nature, those expenses now will qualify as part of your other non-payroll costs and, kind of putting it in, the 40% bucket. The thing that they also talk about, which is kind of a little bit nebulous when you read the law, is when they refer to these expenses, they say that they're these expenses that have been incurred prior to the beginning of your covered period, unless you're under a contractual obligation that you entered into for the entire period, or things that you might have purchased via a purchase order that you're now obligated to buy, again, entering into them before the covered period and then having to pay for them during the covered period. So again, and just kind of going back to the fundamentals, covered period means the date that you received the loan. That's the beginning of the covered period. So, right now, this is what we see in the law. Is it subject to change? Very possibly, but as we look at it right now, so just have to be, keep that in mind in terms of some of the expenses that are now eligible. And like I said earlier, you'll see why that's so important.
Yeah, that's a really good point. So basically, the way I would sum it up is, if you have a purchase order that you're entering into, like you do a purchase order every week with a supplier for non-perishable goods, if those purchase orders are happening during the covered period, that's not covered. I don't agree with that, obviously. I would like to see that covered. But the way they've written the rule, it appears that that does not count because the purchase order was not entered into prior to the covered period. So just, keep an eye out for that wrinkle. And like Steve says, we'll talk about this more, but I mean, spoiler alert, what you want to try to do to maximize the ERC credit is try to get a 60-40 split as close as you can. So you want to do 60% payroll, 40% other non-payroll costs and payroll costs to the extent you can, because that frees up a wage that you can then use potentially get the ERC credit for. So there's some potential dollars on the table there, not in every situation, but we'll cover that when we get to the ERC credit section, but just wanted to preview that because it's relevant to this non-payroll cost issue. Okay, and loan forgiveness. So this is an issue that the SBA has just given a massive punt to right now. They said they dropped about 120 pages of regulations, including a bunch of FAQs that just went out this morning, by the way, that Steve and I were studying prior to this, but none of them address forgiveness and they don't address audits. So they said they'll put out more information about that later. They haven't said when. So this is all kind of just information that we believe to be the case based on the law and based on our experience with the first draw loans, but this remains subject to change, certainly. But what we do know is that you can get forgiveness for up to 100% of the loan. They still have that 60-40 split. So 60% have to be spent on payroll costs and no more than 40% on those non-payroll costs that we were just talking about. We do know you have to maintain certain employment levels, and I have in the appendix here the current FTE safe harbors, but those are subject to change. They have one big question that I still have. They have not said what the base period is where they'll be measuring employment. So Steve and I were talking about this earlier. You know, a client asked today, should I be using 2019 or 2020 to calculate my loan amount? And if I choose one or the other, is my base period for measuring employment going to change? Very good question. The SBA has not addressed that. So just keep an eye out for that issue, that we're not clear when they're going to measure the FTE reduction period from today. For loans under $150,000, the borrower is not required to submit a full forgiveness application. They just have to certify that the funds were used for allowable purposes. But keep in mind, even if you're in that category of automatic forgiveness, you still will be required to have an audit file kind of backing up your eligibility in case you're ever asked. But you're not going to be required to submit that on the front end to the SBA. And then audits and reviews for first draw loans where a borrower and its affiliates, so back to that definition of affiliates, have loans over $2 million, they'll be automatically reviewed by the SBA. And a question I have is whether that $2 million level will include second draw loans or if that will be a totally separate audit process. We just don't know that yet. So there's still a lot that we don't know, unfortunately, about second draw loan forgiveness, but this is what we know as it stands today. One other point, you can submit a forgiveness application anytime up to the maturity date of the loan, which could be 2 to 5 years. But keep in mind that you do have to begin making payments if the loan application is not submitted within the first 10 months after the date of the borrower's covered period ends. As soon as you submit the application, it kind of stops the clock and the loan forgiveness payments will be deferred until a determination is made. So even though you can apply at any time, you probably want to do it within that 10-month window so you don't have to start making payments.
So Morgan, one of the things I just wanted to
Sure.
point out was that, you know, as you're going through the application process for your second draw, some of your banks might be telling you that, look, we're not going to accept your application for your second draw until you've submitted your application for forgiveness on the first draw. And that's not SBA law as far as I know, Morgan. I don't know if you know something different.
Right.
That might be the bank's preference, but it's not part of the SBA law.
Correct. The law says you just have to either have spent the funds or you will have spent the funds by the time of your second draw loan disbursement. So you don't have to have applied for forgiveness yet. You just have to have used all the first draw funds or will have used them by the time you receive the second draw loan. That's a good point. Yeah, I mean, I would say generally in this process too, like if you hear something from your lender that doesn't sound right, definitely check in with counsel because lenders have not been completely correct in my view on their advice in this process. And, you know, to be fair, that they're held harmless, you know, so they get to rely on the borrower. So it's on the borrower to get it correct. All right, so I'm just going to go through a couple of details. So calculating the max first draw loan amount. Again, you aggregate this definition of payroll costs from the last 12 months of the calendar year or from 2019 or 2020 for employees whose principal place of residence is in the U.S. Seasonal businesses have a different calculation. Keep that in mind. You subtract money paid that's over that 100K cap. We still have that $100,000 cap to deal with. And that is your annual payroll cost. Divide that by 12. And you then multiply that amount by 2.5. And that's your total borrowing amount for the first draw loan. A lot of people have asked if they are able to increase the amount of their first draw loans. There are a few circumstances where you can do that, specifically if you didn't know to include partners for partnerships. There's some seasonal employers that may be eligible for higher loan amounts. But for most borrowers, unless you have returned some of your PPP funds or returned part of them, or you didn't accept the full amount that you were originally approved for, then you probably can't increase the loan amount, which even though, you may be eligible for a different amount now than when you first applied. I mean, it kind of makes sense because it would be just kind of an administrative nightmare for them to open it up to every single PPP borrower to increase their first draw amount. But again, there are a couple of situations where you may be able to do that. So talk to your lender if you're interested in trying to fit yourself into one of those situations. And here's the link to the application. And again, I pointed this out before, but I'm going to do it again. Even though there's no law that requires this economic necessity certification, it does appear on both the first and the second draw loan application. So we will expect that, in practice, borrowers are being asked to make those certifications. So for second draw loans, to be eligible, you have to have been operating on February 15th, 2020. Again, for the NICS code 72 entities, not more than 300 employees per physical location. For all others, it's not more than 300 employees, including the employees at all affiliates. And then to Steve's point earlier, you have to have received the first draw loan and have used or will use the full amount of it before the loan disbursement date for the second draw loan. A 25% decline in gross receipts, which we're going to talk about a lot in a minute. And the same special rules for the seasonal businesses apply to both first and second draw loans.
So Morgan, if I can cover a real life issue that I have with a couple of clients right now that you and I touched on earlier that, could be a make or break kind of situation. So, as they talk about one of the requirements of getting the second draw is that you must, agree, not that you had to use it by the time you apply, but you had to agree in writing that you're going to spend all of the first draw money on permissible expenses. So the question then becomes as well, and again, I have this situation with two clients in New York City where they've been negatively impacted by the pandemic. They haven't been able to pay their rent. Their landlords, I should say, have plenty of tenants that are like them, that are, who have been unable to pay the rent. They're still negotiating with their landlords. And now what's happened is, and they were planning on using that PPP money to pay the rent, but they can't negotiate a deal with their landlord. The problem that they're encountering is not only are they not having the money to pay the landlord, not coming to a deal, but the covered period is now expired. So you're now dealing with a situation where you have rent that you owe that you could theoretically pay, but it's outside the covered period, which would then mean that if you paid it, yes, it would be a permissible use of the funds, but it wouldn't be forgivable. So now you could be out of pocket the money without getting the SBA to forgive it. Yes, you'd have a loan at 1%, but you wouldn't have that forgiven. So one of the strategies that we're working on with our clients that will help negate that is, agree that you're going to pay your bills, but maybe use other dollars that you were earmarked for the rent. Use more of your payroll per se if you can do that. Hold off paying your rent until your next covered period starts, meaning that hold off, negotiate with your landlord, agree to say, look, I'm going to pay you the rent as soon as I get my next draw of my PPP money, and now pay those covered expenses or allowable expenses within the next covered period, and now that will be forgiven. But if you end up, falling within the valley, meaning that you're now going to pay your landlord or other expenses of this nature between your covered periods, you can end up being in a situation where you're not going to have that money forgiven. So it's a real critical element that you really need to pay attention to.
Yeah, that's a really good point, Steve, because, you're allowed to use PPP for expenses that were incurred prior to the covered period but paid during it, but you can't do the opposite. So if you paid it prior to the covered period, you can't now use that as a PPP expense. Okay, so this is a question a lot of people asked about, obviously, because it's a requirement now that is new. So you have to demonstrate this decline in gross receipts. So you have to either have experienced a year-over-year decline in gross receipts equal to 25% in calendar year 2020 as compared to calendar year 2019, which can be established by submitting annual tax return forms, or experience a decline in gross receipts equal to 25% per calendar year quarter. And you can establish that by submitting quarterly financial statements. And they've got a pretty complex definition of gross receipts, but basically it's all revenue in whatever form. And a lot of people asked about this specifically with respect to nonprofits. And they came out with FAQs this morning that made clear that revenue does include gifts and donations. So that's a big one for nonprofits. So it's all revenue in whatever form, from sales of products, interest, et cetera, all these different categories. Generally, receipts are considered total income plus cost of goods sold. And then there's a bunch of exclusions here, which I'm not going to go over in detail, except to note that if you're in an affiliate situation, they do exclude from gross receipts transactions between a concern and its domestic and foreign affiliates. So intercompany transactions are not supposed to be included in the definition. So that could kind of complicate the analysis. And
so Morgan, just to kind of go back to that a second. So just a couple of things to take note on. So first and foremost, the calculation of gross receipts is based on your accounting method, which it's in the outline, but I thought it was important to impress that upon people. So if you're a cash basis taxpayer, it's based on cash collections. If you're an accrual basis filer because you have bank loans, or that's how you kind of recognize revenue within your business, whether it's internal or external reporting, then it would be based on accrual basis revenue. The other thing to just consider is that what is excluded from gross receipts will be EIDL grants, PPP forgiveness. Those have clearly been noted as being excluded from income. There is still some uncertainty about the inclusion of some higher relief funds like HHS money that you might have gotten and things like that. We don't know whether that's going to be included or not at this point in time. And then the other thing that I think is important is, like, in terms of a challenge of trying to figure out what your revenue is and how one would go about doing things. Morgan, pointed out in her outline that transactions between related companies that are part of an affiliated group, in terms of the revenue side, is excluded. So, in a typical environment where maybe you are in a real estate business where you have a management company that's owned by the same people that own the real estate, or in a medical or a dental concern where you have a management company that's, again, same kind of intercompany relationship. And one says, well, gee, if I'm going to exclude the management fees that these practices or real estate entities are paying over to my management company, well, how am I supposed to, apply the rules with regard to the 25% reduction, right? Because if my management company doesn't have the revenue, or it's being excluded from the calculation, yet I have the payroll, and the PPP loan is based on a multiple of payroll, how is one supposed to apply? So it seems to me, at least, that the best way of going about that, unless we get further guidance, would be to look at the entire configuration of the group, the affiliated group, and consolidate them and say, okay, well, gee, you're not going to let me take my management fees, but I do have these costs, so let me look at the entire group as a whole and measure whether, again, and eliminate the management fee income, but also eliminate the management fee expense on the other side and say, okay, well, what is my overall revenue, and has it increased or dropped, more than that 25%? And if it has, then I'll take into consideration all of the payroll, including that payroll of the management company. So, otherwise it would be inequitable to look at it any other way. So I think that's a real important point that you should take note of in terms of determining how one goes about their application. And then just as important is whether you qualify. And you'll find that's going to be relevant later on the ERC as well.
Yeah, really good point, and really good segue into the next part of this definition. But it's pretty clear to me that they do want you to do this on a consolidated basis. First, because this specific line item, which excludes intercompany transactions, but also because they have a specific definition for gross receipts of affiliates. It says gross receipts of a borrower with affiliates is calculated by adding the gross receipts of the business concern with the gross receipts of each affiliate. So they do seem to want you to have to do it that way, which is definitely going to be a little bit more complicated for some folks compared to others. So, if you have specific questions about how that applies to you, reach out to us. I'm not going to spend more time on it for the purposes of the webinar, but it's certainly an issue that has to be considered when you're figuring out how to demonstrate that revenue reduction requirement. So calculating the second draw loan is basically the same except for this total borrowing amount. Again, just wanted to point out that this for loans for the NICS code 72 entities, you can get 3.5 times your annual payroll costs. But everything else is similar to the first draw loan calculation. We're using payroll costs minus the cap, over $100,000 cap amount to come up with our total borrowing amount. I guess the biggest limited there is that for second draw loans, the max is $2 million compared to the $10 million for first draw loans. And here's the application. Again, not entirely consistent with the law, but I would definitely note they are going to be apparently asking you to make that economic necessity certification. So you should have documentation in your files that substantiates your ability to do that. And now we've come to the CLE information for all of my lawyer friends. The attendance verification code for CLE is NPCLE 11921. Again, the CLE attendance verification code is NPCLE 11921. And now we have come to the ERC and tax credit update, which has a lot of interplay with the PPP issues that we were just discussing. So it's a really good follow-up to those taking this program. And Steve, you want to take it away?
Yep, sure. So, one of the things that was really not focused on much last year, meaning 2020, was the employee retention credit. And the reason why people didn't really focus on it was because if you claimed a PPP loan or received a PPP loan, you were excluded from taking advantage of the employee retention credit. What as a result of the stimulus act that was passed at the very, very end of the year did was they basically went back and said, well, we told you that the loan would negate your ability to claim the credit. Well, that's no longer the case. You can go back now and claim a employee retention credit. So just because the rules change from year to year, I want to kind of go back to the old rules as it related to 2020 because they still apply to you, given you are now eligible potentially for the credit. And then we'll talk about how that's changed in 2021 so that you can, evaluate, how you can benefit from that as well. So as I said, first and foremost, it now applies, just to reiterate, applies to 20 and 21. Under the old rule, you had to have suffered a reduction in gross receipts of more than 50% in any quarter. And then from that point on, once you've suffered that reduction, you are able to be eligible for a credit up until the point that you achieved 80% of the revenue from the prior year. The credit was based on employee wages, and the wages were capped at $10,000 per individual. And you were able to get a credit of up to 50%, or call it $5,000 per individual, provided you fell within that, those parameters. The other exception to that was if you didn't have a reduction of revenue of 50%, but your business operations were either fully or partially suspended due to a government order, government order of a shutdown, that during that period of time, you also could have been eligible for the credit. The definition of the revenue is pretty much the same as what we talked about earlier. Again, it does exclude PPP and EIDL grants. The other important element, so in terms of looking at the expansion of the expenses that qualify, so just to kind of go back. So one of the things that I didn't mention that's very important is that if you're claiming wages for PPP, you cannot claim those same wages for the employee retention credit. So you have to kind of pick what you want, kind of chocolate or vanilla, in terms of determining which way you want to go with the eligible wages for which you're looking to get either a forgiveness or a credit. And
Steve, that was like apropos of our point earlier that you may want to try to use more non-payroll costs so you can free up that wage so you can take the ERC credit for it, right?
Exactly right. And with the fact that you now have more expenses that can kind of qualify into that 40% bucket. Like, I can't tell you how many clients we had that said, I'm not, we wouldn't even discuss the credit because they weren't even going there because they were getting the PPP money. And they said, oh, look, I don't need to worry about all my rent and all my other, valid expenses. I make the PPP forgiveness with just my payroll, payroll alone, so I'm not going to even bother. Well, now you have this opportunity to go back and revisit, well, gee, I just want to make sure I hit the 60% threshold for payroll and let me stuff as many expenses as I can into the 40% box, meaning my non-payroll box, so that my first obligation is to make sure I qualify for PPP forgiveness. My second obligation, now again, provided you fall within this fact pattern for 20, again, 21 is a different story, which we'll talk about. But as long as I can meet if I met that fact pattern or the 50% or the partial suspension of operations, I now have this opportunity to go back and revisit those other opportunities to claim the credit. Give you a very simple fact pattern. So you can juggle the money between the 40 and the 60% buckets. You do that. The other thing that's overlooked is, let's say your first quarter that you had this 50% reduction was from April through June. You went out and you went and applied for a PPP loan and you didn't get the money till May 25th. Well, guess what? The payroll that you incurred from April 1st till May 25th was not expenses that were eligible to be claimed for a PPP forgiveness. That is now all eligible for employee retention credit, at 50% of wages up to $10,000. So, you have a lot of opportunities to go back and look at in terms of trying to get these credits for 20. One of the questions that, we were asked, and, we've talked about this within the profession, is, well, gee, what if I've already submitted my application and I ended up claiming more payroll than I necessarily needed, or I had these other expenses? Should I go back and amend my application so that I can lower my payroll because I can fit this, within the 40% bucket? And, although we haven't gotten guidance yet, everybody that's, that's informed within the program is saying that they don't think it's going to be necessary to go back and file the amended application, but you should still have this internal calculation as to how you would have qualified for PPP, and then do that calculation to see, well, gee, if I lowered my payroll, still made my PPP requirement, do I now have these wages that I am now eligible for which I can claim the credit? For sure, if you haven't filed your application, and we've told, as soon as we learned about this, we basically hit the pause button with all our clients that were looking to file for the forgiveness to say, hold off, we're going to recharacterize the form to see if you're eligible to take advantage of the employee retention credit, because we're going to file the form so that, you have the maximum flexibility. So that, I think, is something that's really important to note as well. As it relates to 2021, different set of rules. The rules are as follows. First and foremost, you don't need to show that you had a 50% reduction. You only need to show that you had a 20% reduction. So it's possible that, as we'll talk about it a little further, but it's possible that you're not going to meet the PPP forgiveness because you didn't have a 25% reduction. You only had a 20% reduction. So therefore, all of your payroll would then qualify, up to the $10,000 cap, would qualify for ERC ERC credits in 2021. The other thing that's noteworthy as well on this is that whereas in 2020, you were limited to 50% of comp up to $10,000 for the year. It is now 70% of comp of $10,000 per quarter. So right now, the employee retention credit is eligible for wages paid through June 30th, 2021, or 2 quarters. So in effect, you've now taken that credit from $5,000 to $14,000 because you're getting 70% of 10 per quarter, as opposed to 50% for 10 per year. So again, that's another important point as well. Morgan, if you could advance the slide. Thanks. So just to kind of help navigate, Morgan and I have talked about different measurement points and different percentages. So just to kind of take a step back to maybe you mark it on your outline or on a piece of paper, but the key measurement points are as follows as it relates to these new laws. As it relates to PPP, we're looking at a 25% reduction in any quarter for 2020 over 2019. As it relates to ERC, you're looking at revenue for 2020 over 2019 for that 50%. But when we get to the ERC for 2021, we're looking at our revenue for 2021, the 20% over, again, going back to 2019. So again, these are all important elements that one has to kind of keep their eye on the ball as it relates to that. Again, same thing as I said earlier, you can't claim wages for ERC in 21 that you're looking to get a PPP forgiveness on. The other elements that I think are important to note, as it relates to ERC for 2020, it was only eligible to small businesses with some sort of change to it, which I'll explain, where you had eligible employees who had 100 or fewer full-time employees were eligible to get this credit, irrespective of whether these people were working or not. If you had employers of more than 100 full-time employees, the wages were only eligible if you were paying people not to work. And then the way one was going to evaluate as to how much pay would qualify, it was effectively 30 days worth of pay that they were earning while they were working as your measurement point as to pay somebody not to work. Those rules have changed in 2021 now to 500. So what the 100-person rule has now become the 500-person rule. In order to get the credit, you have to be maintaining and carrying on a trade or business for which the credit is claimed. So we covered that as well. They've now expanded the definition of wages to include health insurance. So if you have somebody on furlough who you're not paying payroll for, but you're still continuing to pay their health insurance, that is not taxable to them because it's part of their non-taxable fringe, if you will, that qualifies as well. So again, that's just as important in looking at the overall credit calculation. Just like they're limiting the ability to get PPP loan forgiveness on wages, you also can't double dip the tax benefit for other credits like the Empowerment Zone Employment Credit, the Family Medical Leave Act, or R&D credits. So those, so if you claim the ERC credit, you can't claim those credits for those as well. Okay, so next slide, Morgan. So now to segue to the tax aspect of PPP as well as other tax initiatives that were passed through the end of the year. So, at the end of the year, they passed the Stimulus Act, it's kind of like as the world turns in terms of what we were dealing with last year as it relates to the taxability of PPP. Up until 3 weeks before the enactment of the act, the IRS came out and said that, yes, the use of the funds from PPP forgiveness was not deductible, and they even went one step further, which drove us crazy in terms of trying to do tax planning for our clients. They even said, well, we don't even care if you didn't apply for the loan yet. As long as you intend to have that loan forgiven, it will be the expenses that you use the PPP loan for in 2020 will not be deductible, irrespective of whether you applied or not. All that's changed. That's all off the board. So now the IRS has come out and said that the use of the funds from PPP, first of all, the forgiveness is tax-free. The use of the funds are deductible, and not just for the first draw, but for the second draw as well. So no deduction is denied, no tax attribute is reduced, no basis increase is denied. What is up in the air, and this affects partnerships and S corporations, what we don't know at this point in time is we know that the basis will eventually be increased by this debt forgiveness. What we don't know is whether they will allow you to increase your tax basis, and I'll tell you why that's important, in 2020 when you intended to get the loan forgiven, whether you filed or not, or until 2021 when the actual loan is forgiven. The reason why that's important is because in situations where you use the PPP money to pay for deductible expenses, that might have created a tax loss for you. Well, the question then becomes, in order for you to claim a tax loss within a partnership or an S corporation, you need basis. If they're not allowing you to increase your basis until the loan is actually formally forgiven, then you may not be able to claim that loss in 2020. It may be claimed in 2021. By the same token, if you ended up taking that money and then distributing it out, and you ended up taking what we call distributions in excess of basis, that may in fact be a capital gain to you, or some sort of income recovery if the IRS doesn't deem it to be that you can increase your basis in 2020. We don't know what the ultimate outcome of that is going to be. We've taken the more conservative approach as it relates to tax projections. Clearly, we're not going to take a formal tax position or file a return until that has been resolved. We're hoping that gets resolved sooner rather than later. And then the other element that you have to be aware of is, beware of state regulations, because not every state municipality is going to follow the federal in terms of how they're going to treat PPP forgiveness. We just learned on this past Friday that New York State has agreed to follow the IRS's position about the tax treatment of PPP. We did not know that. Nobody knew that until they passed the law this past Friday. So what we were doing with our clients was advising them of the uncertainty, again, taking the more conservative approach of just making sure they were covered for safe harbor, so that we wanted to make sure they avoided any penalties. It's a wonderful occurrence that now the feds and the government and at least New York State and New Jersey and a number of other states are following the federal guidelines. At this point, California has not weighed in, so we're still waiting for California to see what their position is as well. But everything that I'm reading in terms of what states are coming online, and they're coming online every day. Indiana and Illinois were a couple that came up yesterday, and so we're following this closely. And many of them are following the federal guidelines, but that doesn't necessarily mean that they all will.
Steve, have any states said they won't follow the federal guidelines?
I don't remember, actually, to be honest with you. So we're waiting. I know California is still up in the air. That much I could tell you. And yeah, we were thinking that actually, because New York has been so severely hurt by the pandemic, that they might be one that wouldn't follow, but thankfully they did. So we just have to stay on top of this. And for the folks that are out there listening, please be in contact with your advisors, or feel free to reach out to Morgan and I, and we can certainly keep you abreast of the situation as it relates to that. I think we have one more slide to cover, Morgan.
Yep.
So the last one is just, again, other tax provisions. They've come out and said that the EIDL grants, those $10,000 grants that you got, not only are they excluded from calculation of your gross receipts for ERC or PPP, but they're also going to be tax-free. In an effort to kind of provide a boom to the restaurant industry, business meals are for 2021, not 20, but for 2021 will be fully deductible. In the past, they were only 50% deductible, and I just want to make another point on that. So entertainment, which you would think would also have been covered within these guidelines, because right now entertainment is not deductible at all, 0% deductibility. That has not been that law has not been amended. So even as of now for 2021, which we're in, by the way, 2021, I lose sight of all the years because we're following 19, 20, 21, right? That is still not deductible. And then they increased the charitable deduction above and beyond the standard deduction. The CARES Act originally said, okay, we're going to throw you a break. We'll let you deduct $300 for charity above the line. They've now increased that to $600. So, so those are some of the important elements that came about as of the Stimulus Act at the end of December. That's above and beyond all the law changes that changed, back in the CARES Act, whenever that was, April or May of earlier in this year.
One more point I meant to make earlier that I'll make about EIDL. So originally, you may recall, those grants were deducted off of your PPP loan forgiveness amount, but they've changed that, and they've changed it retroactively. So if you had an EIDL grant and it was subtracted off your loan forgiveness amount, that amount is supposed to be remitted to the lender and ultimately get back to the borrower. So I'm not sure how that process is working administratively. But if you are in that situation, definitely I would reach out to your lender to see what their plan is. And then going forward, if you can get both the EIDL grant and full forgiveness on the PPP loan. So that's a good new change as well.
Yeah, that's great that you brought that up, Morgan, because I meant to mention that to you as well. I've had a number of clients, especially when they're dealing with the community banks, who are certainly less sophisticated than the large regional banks, and they were, giving some of our clients a hard time about that. So hopefully they'll become, we'll bring them up to speed, and the folks on the call today will as well, because they're certainly less prepared to deal with these things. I mean, they're much better in terms of processing the loans. They seem to be the ones that get the loans done the quickest. But in terms of understanding the grander scheme of things, I think they're a little bit limited. And I hope I'm not offending anybody on the call.
No, it's just, they're learning it in real time like we are. They're reading the regs and trying to figure out how it applies, and they don't get everything right all the time. So, I've had several situations where we've jumped in on behalf of a borrower to try to help educate the lender, especially around that change in ownership guidance that came out last year when you were trying to do an M&A deal that involves a PPP loan. A lot of banks weren't up to speed on that. So there is some, something to be said for educating the lender on what they need to be doing.
Yeah. I think we have a couple of minutes for some questions, maybe.
Yeah. Does anybody have any questions? We tried to address the ones that were submitted in advance, but you can, Susan, can people put them in the chat, or how else can we take questions here?
People can enter them into the Q&A box and then submit them.
Okay.
And hit send. Yep.
Yeah, so let's see. Some of these we've answered, but just in case somebody missed it. Can the covered period be any 8 weeks within the 24 weeks? Say weeks 16 to 24. So the covered period still starts on the date of the loan disbursement. You can't decide to start it later. You can only decide to end it later. That's my understanding.
And one of the issues that we had in terms of people where they wanted to cut off, right? So, so a lot of people were concerned, well, gee, let's say I can spend the money within 10 weeks and then I'm going to lay off a whole bunch of people. What do I do in terms of submitting my loan forgiveness application? Because I want to be able to do that, while I still have my full head count, so I don't suffer that penalty, right? So I think these laws have kind of helped clarify that. Am I right, Morgan?
Yeah, I think that's right.
Yeah.
There's another question. Does loan forgiveness begin 10 months after the end of 24 weeks or 10 months from the loan funding? So the thing about the 10 months, that's for your loan payments. So your principal and interest payments are deferred for 10 months after the end of your covered period. So that's the end of that 24 weeks. For 10 months after that, you don't have to make payments. And you can apply for forgiveness anytime, but up to the maturity date of the loan, but you probably want to do so before you start having to pay the loan back.
Right. And I guess your point earlier, just to clarify for the person that asked the question, is once you apply for the loan, you basically freeze the loan payments, but your loan is forgiven when it's forgiven. I mean, when you get notification, that's when it's forgiven.
Right. Someone asked, if the borrower applies for a second draw, when and how will they apply for forgiveness on draw one? Right away after receiving the second draw? So there's no restrictions on when. It's the same time period applies for applying for forgiveness. It won't be affected by whether or not you take out a second draw loan. The only thing you have to make sure of is that you've spent the first draw loan by the time you get the disbursement of the second draw loan. But you can apply for forgiveness still anytime up to the maturity date of the loan, but you probably want to do that before the 10 months window when you'll have to start making payments. Let's see. Can you please explain again how we should apply if we have an MSO, DSO with a management company structure? That was from Brent. That's a pretty factually specific question, but maybe we can follow up offline about that one. Michael Sullivan says, I have a number of clients who meet the 25% reduction in revenue for the second quarter, but bounce back in the third and fourth. Please discuss whether or not these clients should take a second draw loan. They may have cash on hand at the end of the year. So that's an interesting question. So this goes to this issue of the fact that although it's not in the law, the second draw loan application still is requiring companies to make that economic necessity certification. So you may be able to meet that revenue reduction requirement for Q2, but maybe you're doing really well and you do have a lot of cash on hand. And, you have to consider that when making that economic necessity certification. You have to consider your sources of liquidity. So I can imagine a situation where, you'd be able to meet the revenue reduction eligibility requirement, but you're not able to make that economic necessity certification in good faith. So you do have to kind of consider that interplay.
Right. And just to reiterate, again, you just need to meet one quarter. I mean, from the measurement point of view, but the certification is a whole other, ball of wax in terms of, again, that's a separate issue. You have two. You have to meet. If you don't meet the revenue one, you can't go to the certification. But just because you meet the revenue doesn't mean that you're automatically certified. You have to look at each of them together.
That's right. All right. Last question is from Jen Beldew. Hi, Jen. She says, if we only use payroll for forgiveness on the first PPP loan, can we use the other expenses on the second? That's a good question. So if they were incurred prior, the way it works now, I mean, this is subject to change because they haven't put out the regs on loan forgiveness for second draw loans. But for first draw loans, if you incurred an expense but paid it during the covered period, you can use that for a PPP expense. So it sounds like that's a situation you're considering for the second draw loan. That issue is, subject to change depending on what they come out with for loan forgiveness. But it's kind of the issue, the hypothetical that Steve gave before about the rent, that you may want to, even though you've incurred the expense, you may want to pay it when you're in your covered period so you can use PPP for that expense.
Right. And Jen, just keep in mind, whereas maybe in 2020 you didn't suffer a 50% reduction, you might be incurring a 20% reduction or 25% reduction in 2021. So you want to be more judicious in terms of how you allocate your expenses. Even though it's easy to do the payroll, you might have this, terrific opportunity to kind of, get $7,000 per employee per quarter as a tax credit. Oh, and one last thing on that. The credit itself is taxable income, unlike the PPP, which is tax-free. The receipt of the credit is taxable. I neglected to mention that.
Yep. And lots of people asked if we're going to make these slides available. Yes, if you signed up for the presentation, we'll send them to you afterwards. And just once again, for my lawyer friends, CLE code MPCLE11921. And big thank you to everyone for following the program, and definitely reach out to Steve or I if you have specific questions about, how to meet the requirements in your own situation, or about how, a lot of the work that we're doing right now involves helping companies paper their audit file and get their audit file ready for the inevitable review process if you're in that over 2 million category. So let us know if you need assistance with that. And thanks so much for being here.
Yeah, thanks, everybody. Thanks for listening.